All right, well, those are the headlines that we are tracking for you all evening on ET Now, so keep it with the channel. Well, first up, let's talk about the different mutual fund categories. As we all know by now, there's not just a large cap fund, a mid cap fund, and a small cap fund, but there's flexi cap fund, multi cap fund, dynamic asset allocation fund, arbitrage, hybrid, balanced, so on and so forth. Lots of categories just in the equity space and many more than in the debt space as well. So what is the role that each of these MF categories play? Are we supposed to have a little bit of all of these categories in our portfolio, or does it just become too much to handle and a logistical nightmare really for us normal retail investors? To talk about this and more, I have with me Mr. P.V. Subramanyam of Subramani.com. Mr. Subramanyam, thank you so much for taking out time. It's always a pleasure having you with us. To start with, sir, let's talk about these different categories. From a large cap fund to an arbitrage fund to a dynamic fund. Why are there firstly so many mutual fund categories? I mean, what's the role that each one plays for a retail investor?
Good question, and I don't think I know the answer very well, because typically a mutual fund house is a manufacturer. He keeps manufacturing a lot of things. It is for the financial advisor and the investor to sit together and decide what to buy. Now, if you are an automobile manufacturer, you have a four-wheel drive, you have a city car, you have all those things. But in case of a mutual fund, I don't think anybody knows very clearly where should you invest and is it the only place where you should invest. So people invest in a mid and large cap fund, in a small cap fund, in a thematic fund, in a pharma fund, in IT fund, and everybody ends up with some 10, 15 funds. Hopefully some will do well and some will not do well. So it's very difficult to say. The manufacturer knows that he has to manufacture all these products. Nobody knows how much to invest in each one. So if you are a simple investor and you think you can handle a simple product, then an index fund is enough for you. But if you think you want more, then, well, more variety is available. Do you need it? In my view, no. But there are so many manufacturers manufacturing so many products and investors wanting to buy it. So I think the market is there for the buyer and for the seller. You don't need it, no.
So how do you advise that a portfolio be split across these different categories? Let's assume that an investor has a long-term time horizon.
It's really very difficult because there is an asset allocator fund which puts money in equity, in gold, in debt, and maybe in foreign funds. How do you know where to put? So you don't know, so you put the money there. Now, when you are putting the money, are you saying that you have only one fund? No, you also have a mid cap, you have a large cap, you have a mid and large cap, you have a small cap. So you just invest because you don't know, your advisor doesn't know. So you just, let's say you want to put 1 lakh rupees, you put 10,000 rupees in 10 schemes or things like that. There is absolutely no justification or rationale to say that this is how it should work. So what happens is sometimes when large cap does well, mid cap is not doing well. So you say, oh, okay, at least large cap is doing well. Sometimes mid cap is doing well. There is nothing to say one can do well and one can't do well. For example, when large cap does well, it means companies like Maruti and Tata Motors are doing well. When mid cap does well, it means their suppliers like say Sona Steering or those companies are doing well. Is it possible that one does well and the other doesn't do well? No, but they all take their turns. Sometimes the large cap goes fast ahead. Sometimes the big cap goes ahead. That's all. If you take a 20-year view, it really won't change much. It'll be 1% or 2% here or there. So it doesn't really matter. But men and women, when they invest, they crave for variety. You go and tell them Franklin India Blue Chip is a good fund. They'll say, हाँ वो तो है. So they need something else. So you then give them an Invesco fund. Then you give them a Sundaram fund, you give them a Birla fund. So people want variety. They will not put all their money in one mutual fund. They will not put everything in large cap. So you have to give them large cap, mid cap, flexi cap, multi cap. These are terminology created, and believe me, even if you get an expert from the fund house and say what each fund does, without allowing him to look at the sales aid, he will not know what each fund does. There are just too many schemes. They are meant more to confuse people than to help people.
So basically, Mr. Subramanyam, let's say if I pick 3 large cap funds and I put them in my portfolio versus I take 1 large cap, 1 small cap, 1 mid cap fund, they both will serve me the same purpose of giving me equity exposure and will help me create wealth in the long term. Would it be the right way then to put it?
I really don't know, because I can always pick up 3 large cap funds. Say one managed by Naren, one managed by Samir Arora, and one managed by Ramdev Agarwal. Believe me, all the 3 portfolios will look very different, even though all the 3 of them are large cap funds. Ramdev will be a more aggressive portfolio. Samir Arora could be, it could be a less aggressive one, and Naren will be more least aggressive. Naren could have perhaps 100 shares, Ramdev could have 25 shares. So there also you have some variety. You can have large cap growth, you can have large cap value, you can have large cap growth and value. Believe me, it doesn't really matter. So what normally people do is put 60% say in large and mid cap, then about 20% in mid cap, and another 10-20% in small cap. That is how we normally build a portfolio, saying sometimes this will move ahead and sometimes that will move ahead. What happens is, if you don't give a client all the varieties, then there is FOMO, because he is going to say, oh, abhi small cap is doing well, I don't have any small cap, so he will want some small cap. So it is more to meet the client's FOMO requirements that he needs such a variety. Otherwise, I don't think he needs so much of variety. I don't know whether he will be able to explain over 30 years or 20 years. You will not be able to say which combination will work. Therefore, you take a safe way out and say, okay, 3 fund houses, 3 schemes, one large and mid cap, one small cap, and one multi cap or flexi caps, that kind of a thing. There is absolutely no way how you will know over 20 years which will perform better.
Okay. That's fair point, Mr. Subramanyam, really. What about these funds which are not purely investing in equities? You have arbitrage funds, you have thematic funds as well, for that matter.
And 1 minute.
They have a very different objective and goal. Sure, go ahead.
An arbitrage fund is basically a debt fund, okay? It sells in one market and buys in another market. It's basically a money lending fund. So it will give you returns like a debt fund. However, because it buys and sells equities, it is treated like an equity fund for taxation, but that is just a misnomer. It may change any time. All other funds try to tell you that if this is the only fund in which you are investing, it makes sense to have an arbitrage balanced fund, which puts some money in equity and some money in debt. But if you're anyway investing in debt and equity separately, you don't need it. Now, there are some investors who understand that debt and equity investment need not be combined. But the other advantages in a balanced fund, when the fund manager buys equity or sells equity and buys debt, you don't have to pay tax. Whereas if you try to do it yourself, if you try to do the balancing yourself, you sold equity, bought debt, you sold debt, you bought equity. When you do all that, you pay taxes on that. So that is the advantage of being in a fund which is say 70% in equity and 30% in debt. It gets taxation like an equity taxation, and the fund manager does all the balancing for you. So that is an advantage, that you don't have to do the balancing. So the fund manager does it for you. So you pay tax only when you withdraw.
Okay, understood. What about the argument that some funds do tend to carry a little less volatility and thus, from a risk perspective, help in diversifying your portfolio?
Mubina, risk volatility in equity fund is not possible to say I don't want it at all. For example, I've always been saying this, when you're flying from Bombay to Delhi, it is possible that the flight has some turbulence. Turbulence is volatility. Volatility should not scare you. It scares people, but it should not scare you. You're only afraid of a crash. Turbulence will always be there. If you think you can enter the equity market and say, I don't want volatility, it is not possible. It's teaching your stomach to handle volatility that is important. Yes, some will be less volatile. Therefore, you will have a fund which has got, say, equity and debt. So, therefore, it will be less volatile. But remember, that will also give you less returns. So when the market goes up, this won't go up as much, and therefore people will come and ask you, but you asked me to invest in that, that has not gone up so much. Obviously, it won't go up so much because 50% of that is equity and 50% is debt. People want a balanced fund when the markets come down, but they want an equity fund when the market goes up. You can't get the returns of equity with the standard deviation of debt. You will have to take both together. So it's largely a fund which only calm people can put money, but people who feel that they should ride every top of a equity fund, for them this fund is not a good fund. So it has to be a very relaxed and a nice person to put money in a balanced fund. It doesn't suit everybody. Anybody who's got this FOMO of saying, oh, I want the best fund, I want the fund which goes up the fastest, for them this is not a great fund. Yeah, like I said, when people invest in one fund and they put 1 lakh and then they say, nahi, wo to hai, mere ko naya kuch dikhao. You know this or dikhao, the Amazon ad which says. So similarly like that, people want variety, people crave for variety. So manufacturers give them variety. So that's it, it's a made for each other kind of a thing. Do they need it? No.
Okay, well, here's one very unique, thing that we've been seeing recently, and that is that a lot of investors have been pouring money into thematic funds, perhaps because, some of them have given great returns as well. And again, like you said, right, mutual fund houses as well are giving what investors want. They're seeing pharma rally, they're seeing IT rally, and thus we're seeing NFOs as well come around in those segments, which is again in turn leading to more money being directed in that. But would you recommend thematic funds?
Again, Mubina, thematic fund means lot of themes, right? So would I recommend a thematic fund means you're asking me, would I recommend a pharma fund, would I recommend an IT fund, would I recommend a banking fund? I do not know which theme you're talking about, because all of them get clubbed as thematic fund, like how ELSs get clubbed. Now, one ELSs can be a large cap, one ELSs can be mid cap, one can be a flexi cap. So similarly, which thematic fund are you talking about? Everybody has already put money into the US funds. US funds are collecting money like anything. Then there is pharma fund which is collecting. Now IT fund is collecting. Actually, I would look at thematic like this. I would look at a thematic fund which has done very well. I would actually exit. I would put money in a thematic fund which has done very, very badly. If there is a fund which is doing very badly, that's a great fund in which I would invest. I would not invest in a fund which has already given some 60-65% return last year, which could be the pharma funds. So I would be afraid to put fresh money into it. If I've got old money into it, I may just stick around. But fresh money, I would be afraid to put. But if I pick up some fund, let's say, I don't know, but suppose there's an infrastructure fund which has not done well at all, I would put money in that. But I do think that infrastructure fund and banking funds have all done well. This is a market where I find it very easy to spot funds from which to exit than funds which to enter. So I don't know whether I would recommend any thematic fund at this stage. I'm scared.
Well, yeah, I mean, of course, I understand there's banking and financial, there's pharma, there's IT, so on and so forth. But I think the idea was just to get a concept of whether investors should invest in thematic funds at all. Because, it may do well in these last 18 months or 24 months, and then it may not do well for the next few years. So I guess that's why the strategy as well. Something that's already done very well, maybe stay away from it and instead go for other thematic funds, if at all you do want to invest in a thematic fund. Okay, I think we'll take on both some questions and queries then. Ladies and gentlemen, if you'd like to connect with us, you can do so via our email address, themoneyshow@etnow.tv. So our first query is coming in from Mr. S. Bala. He asks, should I invest in the balanced advantage fund right now, as there is a lot of volatility? And I think when he says a lot of volatility, he means in the equity markets. Mr. Subramanyam, what should be a strategy if you want to invest, but then you don't want the volatility that's associated with the equity markets, something that you alluded to as well during our Q&A.
Yeah, Mubina, you are a Bombay girl. You've been to the beaches for sure, right? So if you wait at the shore saying, I will step into the water after the waves have stopped, you will never step into the water, right? So it's something like this. Can you do away with volatility in equity markets or even in debt markets? The answer is no. You have to learn to manage volatility. You cannot say, I don't want volatility. Then you go and put money in bank fixed deposit or PPF. There will be volatility. If you can't handle volatility, put small amounts of money. If you can't handle, put 5,000 rupees a month. Don't put 50,000 rupees a month, depending on how much you are earning. So then after 2 years, 3 years, you will see that yes, there is volatility, but the returns are superior. So you will get superior returns, but there will be volatility. You can't wish away volatility in the equity market. You can't wish away volatility even in the debt market. So where is the question of wishing away volatility? Are the markets volatile? Yes, but markets have been volatile for the last 200 years. When have markets not been volatile? It's only a question of more volatile or less volatile. So don't wish away volatility. You can't.
When you invest, volatility is inevitable, really. Now, here's somebody who's trying to manage volatility. Subramanyam Pichai, he says, I invested 20 lakh rupees a year ago in Axis Banking and PSU. This for his retirement, which will be in 5 years. Now, I'm not sure if there are more funds that are involved here, or is it just the 20 lakh rupees? Now, he says the debt fund return is obviously very low, as it has been in these last 6-7 months. He asks, is it advisable to activate an SWP to invest in equity MF? So I think what he means is an STP rather, where you slowly and systematically move money from debt to equity for 3 years via SIP. Is this a good idea, Mr. Subramanyam, considering the fact that, Mr. Pichai has 5 years to his retirement? He's already put a good 20 lakh rupees in a banking and PSU fund.
Yeah, see, this is typically a very difficult question to answer. It looks like a very simple question, but I need a lot more details about Mr. Pichai. I need to know what is the total amount that he has. Why is he talking of 5 years to retirement? Is he 53? Is he going to really retire? And when interest rates are low, to chase returns is the worst thing that you can do, because you will be taking more risk. Are you understanding that you're taking more risk? I would happily put money in an equity fund in an SIP basis, maybe for 3, 5, 7 years. I don't have an issue. But what is your other portfolio? If all your other portfolio is in equity and doing well, maybe it's time to remove money from equity and put it into debt. You don't put money into equity or into debt because it is doing well or not doing well at that point in time. Because if assuming he's 53 years of age, he's got another 30, 40 years that he has to worry about. In 30, 40 years, the first thing that you have to worry about is preservation of capital, which is what this Axis fund is doing. So if you want preservation of capital, answer is no. But if you want growth, answer is yes. So the question is, what is your overall picture? Well, I mean, how much is your blood pressure? How much is your heartbeat? How much is your sugar? All that, and based on that, I need a full body report and not just this question. It's very difficult to answer this question.
In fact, I'll tell all our viewers that, it's always advisable that when you're sharing something, do so more holistically. So, it's not just enough to know that, okay, you have 20 lakhs in one particular fund and you're unhappy with that fund's return, so now you want to move away. You need to look at your entire portfolio holistically. So it would be better if, Mr. Pichai would share what are the other components of his portfolio as well. And plus, it's not a good idea to sort of book out when, something's not doing very well. Okay, now we have Balakrishna Shetty, who writes in to us saying that I made an investment in the, I think it's in the HDFC Infra Fund. If just a second, yeah, it's a sectoral fund that he's put his money in. It's in the HDFC Infrastructure Mutual Fund that he invested money in 2008. Now he's asking if it is time to redeem that money in the next year. So the infra fund, as we know, I think we've missed that out in our graphic as well. It's the HDFC Infrastructure Fund. Now in that fund, Mr. Subramanyam, of course, infra has not done very well. You sort of spoke about it as well during our thematic fund answer. So yeah, what do you do? I mean, he's been in this fund for 13 years and it's obviously not done much for him. So what should such long-term investors do then?
This is what happens when you invest in a fund when everybody is putting money in a NFO, right? So you have to remove money from a thematic fund when the fund is doing well, and during bad times you have to just sit tight. So if he is happy with the returns that he has got, he should remove. If he is not happy with the fund, then he should wait for some more time. Now, if he had done goal-based investing, and very clearly if he had a goal in 2021 or 2022 or maybe 2024, he would know that he should remove it. If he had just invested, there is absolutely no reason to just remove it, right? You invested without a reason. You should not remove without a reason, right? You should have a reason to remove. But if you think that you need the money, good time to remove, yes. But if you think there is some other fund which will do better than this fund, then maybe it's a good time to remove. But infrastructure, I would not remove now. Just wait. The government has done a lot of stuff on infrastructure. They built up so many new airports. This is a bad time to be removing money from an infrastructure fund. So maybe you should stay around and once you're happy with the return, that is the time to sell. Unfortunately, when the returns are good, somebody will tell you, "Ye to aur upar jayega," and then you don't remove. That's a bad thing to do. You should remove when you're happy. You should control your greed. If you've got a 20% return, it's a great time to remove. Don't wait for 40% return and 80%. If you're not happy with the fund, just wait, because I don't think it's a great time to be removing from an infra fund. No, don't remove.
Okay, understood. So that was the HDFC Infrastructure Fund, a thematic fund that he was talking about. But I think with that, we are out of time. Mr. Subramanyam, thank you so much for joining us. It's always a pleasure having you with us on the Money Show and, helping our viewers out with their questions and queries as well.